Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. Day traders are often looking to make quick profits from buying and selling securities like stocks or exchange-traded funds. And one way they can juice their profit potential is by trading options. For those that aren't familiar, options give traders the right to buy or sell a security at a set price and time frame. Each contract typically represents 100 shares of the underlying security, which means they also let traders take advantage of leverage. In other words, less money is needed up front to trade larger positions and potentially earn bigger profits. Of course, there's also the risk of larger losses too. So we're going to find out how today's guest helps maximize his profits and minimize his downside risk. Plus, he'll answer your questions in our live Q&A session at the end, so stick around for that. Joining us is Zac Hartley, founder of Hartley Trading. Zac, it's great to have you back with us.
Brian, thanks so much for having me back again. I appreciate it.
All right, well, I want to have a second here just to get to know a little bit more about you. For those that may not be familiar, why did you start day trading options on a regular basis?
Yeah, for me, it all started back in university. I took a stock market fundamentals course and started investing my money into the market in general. From there, I got into day trading stocks, and it slowly evolved into learning about options and learning about the benefits of trading options. And so it was a progression. It definitely didn't start with options. It was starting with the basics, then starting with day trading stocks, and then kind of moving on to options for some of the reasons that we're probably going to talk about here. But like you said, leverage being one of them, and the ability to see and realize and take advantage of larger price movements with, like you said, a smaller amount of money up front. And so several different reasons to start with options, but it was a progression for me when I got into it.
Yeah, that leverage aspect can be a really big thing for sure, a big advantage. For those that are, a lot of our audience, I think, will be familiar with options already, but for those that aren't, can you briefly explain what options are and why they can help amplify a trader's potential gains or losses?
Yeah, really simply, at the end of the day, options are contracts that give you the ability to purchase the security or the stock at a given price before a specific date. That date is usually known as the expiration date, and that specific price is known as the strike price. And so if the price of the underlying security rises substantially above the strike price, you are able to realize on that profit in return for a small upfront payment called the premium. And so you're basically paying a little bit of money up front, and if the trade works out in the direction that you are planning or that you hypothesize, the returns can be quick and substantial in comparison to just trading the stock.
All right. Yeah, quick and substantial. That's something I think a lot of people might be attracted to in an option strategy for sure. Getting into a typical day for you, what does that look like for as you start day trading options? Can you walk us through that?
Yeah, the day definitely starts before you sit down at the computer. I think one mistake a lot of people make is they're not in the right mindset, they're not focused, they're not fully awake, and they're not ready to basically go to work. And so for me, the day starts pretty early. It starts with getting a good night's sleep, waking up, having breakfast, going through a morning routine, and making sure that when I walk into my office, I'm ready in a proper mental state to actually make clear decisions. So that's where it starts. After that, everything begins with research. Before you should start looking at what trades to make, you need to look at what the market is doing, what direction it is going in, what news is on the agenda. Are there any major economic events that are happening today or later this week that I need to be aware of? Where are we at with regards to earnings season? And then what I try to do is I try and identify trends in the marketplace. And so over the last little while, AI has been a big trend. Tech has been hot for the last few years. We went through a bit of a cycle with electric vehicles. We just went through a hype cycle with quantum computing. And so what I try and do is I try and identify trends that are happening in the market where I can see a clear direction in the price. And then I try to do research on those trends and identify the underlying stocks that are going to either benefit the most or get hurt the most from that trend. and then I try and evaluate to see which one is going to get hurt the most or the least. And then I look into that stock. I perform technical analysis, usually on a medium to short-term time frame. And then from there, I look for trading opportunities based on that technical analysis. A lot of the times, those trading opportunities aren't going to show up the first time that you look at that stock. And so I try and build basically a short-term watch list where I have identified the trends that I'm looking to trade. I've identified the stocks and the companies that are most interesting to me or where I think there's the most opportunity. And then I watch and I monitor those stocks using technical analysis. And then once I find a opportunity where I think there's a buying chance, I then transfer over to options. I confirm the technical analysis and the direction, and I execute the trade there. And so it is a process where I'm starting with the big picture, and I'm basically working my way down to a 1 minute time frame to execute the trade. But it starts with the night before and making sure you sleep well, making sure you get up and you start the day right, making sure you have a clear head and you can make the right decisions, and then going through a process to evaluate and narrow down all the opportunities that are in the market into the best opportunity that you can take advantage of as a trader. So that's my process in a nutshell.
All right. So to start the day off right, you might have to have a good breakfast to get going on your trading, I would assume.
Yeah, for me, it's like a piece of toast, and I do a green juice, and then I'm usually good till lunch. But everybody's a little bit different. Some people have a big, massive morning routine. Some people can get up and kind of get at it right away. So you got to figure out what works best for you. But you're going to be sitting down at a computer for probably a couple of hours. You need to make sure that you feel good, that you're ready, that you're alert, and that you got a clear head to make the right decisions.
Oh, absolutely. That's fascinating. So just going back, taking a quick step back, I want to get into your process in a moment, but you said you're using technical analysis. So we're looking at charts. And, I know we didn't get into it in too much detail on options. There's two different types of options. There's call options and put options. Can you do a quick explanation for the audience? Okay, how would you use a call option? Just like really briefly, how would you use call options and put options? And what kind of things are you looking at in the trends? What are you trying to identify to decide which one you may use? And is there one you have a preference for?
Yeah, great question. So starting at the top, we're just going to focus on buying call options and buying put options. Buying a call option gives you the ability to purchase the stock at a given price. And if the price of the stock is higher than that strike price on the expiration date, that is the profit that you stand to make minus the fee that you pay for purchasing that option, which is known as the premium. So you are basically trying to make money when the stock goes up if you are buying a call. Buying a put is the exact opposite. You are trying to make money when the price of the stock declines in value. When you buy a put, you have the right to sell the stock at a specific price on a specific date. And if the price declines lower than that, you have the ability to make money on that difference, again, minus the small fee that you pay up front, known as the premium. And so call options help you make money when the stock is rising. Put options help you make money when the stock is falling. Over the last, let's call it 12 months here or slightly longer, we've been in a very strong bullish market. And so my tendency has been to lean towards call options because just on average, a lot of the stocks that I am trading, specifically technology stocks, have gone up. That is not to say, though, that doesn't change. For instance, if we're in a bearish market, things aren't going well, the S&P, the NASDAQ, the Dow Jones are falling off a cliff, that would be an opportunity and a time that I would probably focus more heavily on put options and adjust my strategy to what the market is giving me. That is something to kind of focus on as well, is that that's the reason I start with the big pictures, so that I can understand what the market is doing as a whole and then adjust my strategy from there. And so call options, put options, both are tools. My tendency over the last little while has been to use call options. However, there are a lot of companies out there that I personally don't think are doing very well, or they're in an industry that I think is dying. And in those situations, I would be using put options.
Okay. Well, a great explanation. It looks like you have, I guess, pun intended, you have lots of options, whether it's markets going up or down. So that's awesome to see. All right.
Exactly. And that's it. Sorry, go ahead.
For sure. You mentioned, no problem. You mentioned technical analysis, Zac. So I know that's an important skill, but what are, some of the knowledge pieces and skills and maybe a little bit of how much time commitment do you need to be a day trader of options?
Yeah, so when it comes down to knowledge base and skills, the big thing that people need to focus on is not one technical analysis tool or one indicator or copying somebody's trades. What they need to focus on is understanding how the market works, what actually drives that price movement, how do you actually analyze these charts. And so there's a lot of just basic knowledge that somebody needs to understand, such as how to execute the trades, what are the different order types, how do you draw support and resistance. And so those are the basic concepts that somebody should learn and understand and continue to grow even as they get into this. And then with regards to time commitment, that really becomes a personal preference. For me, what I have found is that most of my trades are occurring anytime after 10 to 15 minutes of market open up until about 2 to 3 hours of market open. And so I'm spending mornings at the computer. I'm doing my work and trading these options, usually right after the market opens to about 2 or 3 hours. And then after that, I'm usually done for the day. I run a business, so I have a couple of other things that I work on, and I analyze the trades either after I'm done trading or before I start the next day. And so with regards to time commitment, it's really personal preference. You definitely need to do the work before the market opens so that you can understand everything I talked about, such as the direction and the trends and what you need to have on your watch list. And then once the market opens, if you make one or two good trades and you feel really good about it and nothing else is showing up for you and it's only 10 o'clock, then call it a day. If you're not seeing anything, then give it some more time. And maybe you don't even make a trade that day, but you sat at the computer for 3 or 4 hours. It really depends on the person. What I have found, though, is that most of the action when it comes to day trading is happening in the first 2 to 3 hours of the market. So that's when you probably want to be at your computer. Anything after that is probably where you're not going to find the volatility that you had earlier in the day. And so as options traders, it's probably less attractive. And so a little bit of research before the market opens, 2 or 3 hours of work more than likely, and probably half an hour of analyzing your work when you're done at any point throughout the rest of the day or before the next session.
All right. Yeah, that sounds like a great process for sure. I know I've got one more big picture question for you, Zach, related to, getting started and things like that. In your experience, how much money did you find you needed to start day trading options? I think there's often a perception that you need a ton of money to get started.
Yeah, this one was a little tricky for me. Back when I started, a share of Google was like $1,200 and Apple was high. So nowadays, you don't need a ton of money. You need maybe a couple $1,000s. If that, you don't need to have a massive position. What you need to think about, though, more so than how much cash you have is, can you just make your standard position size? So if you only have $1,000, but your average position size is, let's just say 10% or 20% of your $1,000 portfolio, what you need to ask yourself is, can I buy at least one contract of that option for $100 or $200? If you can't do that, then unfortunately you need a larger portfolio. So I would say what you need to think about with regards to minimum amount is try and figure out what options or what stock and options you want to trade, figure out how much one contract would cost, and figure out if that is more or less than what you would like to take in a single position. And if it costs you more, then you probably need a larger portfolio, and maybe you want to stick to some other stock or option, or you want to go back to day trading stocks so that you can control it a little bit better. But at a minimum, $2,000 to $3,000 should get you into most of what you want to access when trading options.
All right. Yeah, we've had a previous webinar guest before that Tony Zhang would often say, you want to have enough powder in the keg to fight another day. So, in case something goes wrong and you lose some money, you want to have enough to keep going and going. Would you kind of agree with that?
I would totally agree with that. The last thing you want is to only have enough for 2 trades, and unfortunately they don't go well, and then you've just blown your account. That is the last thing that you want to have happen. If you're in a situation where that is risky or that's a chance of happening, you need to size down, or you need to go to a practice account, or you need to find some other security to trade, because I couldn't agree more with that. You need to have room to live another day, and you need to be able to mentally recover from it. So if you blow up your account and you only had room for 2 trades and both of them went against you, you're really not going to feel good leaving your desk and going back to that computer the next day. And so it's a little bit mental as well. You're way better off having 1 or 2 really small wins than 2 terrible wins or 2 terrible losses. It's just going to destroy you mentally, and it's going to be harder to recover from as a trader.
All right. No, that's great stuff. Thanks so much, Zach. Now, let's hear about your approach to boosting your profit potential by day trading options. So we'll get into some of the details. First off, how would you describe your strategy when day trading options, and how does it help you supercharge your profit potential?
Yeah, so for me, a lot of people have different names for it. A lot of people call what I do scalping options. Basically, I am buying and selling these options for very short periods. I'm not trying to hold for an entire day. I'm trying to hold for a couple of minutes to maybe 10 or 20 minutes. I'm not trying to hold for a long period of time. I'm trying to take advantage of a very specific move that I think is happening in the market. And so my positions are in and out very quickly. It is the idea of I'm trying to buy into a trend or buy into the change in a trend and take advantage of that movement and then get out before that trend changes. So if you think about it like baseball, I'm basically trying to get on first base a couple of times. I'm not trying to hit the home run. I'm just trying to take small profits where I have the most conviction.
All right. No, that's a great analogy for sure. So what are some potential downsides? We always want to look at, we focus on the upside a lot of times, but in terms of the downside, is there a downside to scalping options that traders should consider?
Yeah, there's definitely some big downsides and some major risks that people need to consider. Number one is volatility. These prices just move much, much faster. They move quicker, and you need to be a little bit more aware, and you need to be able to execute your trades a little bit faster than, say, if you were just day trading the stocks or if you were swing trading. So I'd say that's number one. Number two is the spread and the volume of the underlying option becomes very, very important, whereas it is less important if you are handling the stock or if you are doing something long term. In options, the spreads, which is the difference between the bid and the ask, can be much larger than you would find if you were trading the stock. You will also find that the volume is much lower. And so your ability to get in and out of those trades, basically known as liquidity, is much less than if you were buying and selling the stock. And so as a trader, you need to take that into account. You need to add that into your strategy, and you need to make sure that if you're buying and selling quickly like I am only focused on options that have high volume, have high liquidity, have fairly tight spreads, and are options that I can get in and out of quickly. Whereas a lot of smaller stocks that have options, that would be very difficult to do. And so it goes back to what I said before, is you need to understand how this market works. You need to understand what the spread is, how to execute those trades, what is actually driving the price, what is moving these different mechanisms in the market. And that just comes down to basic knowledge about the actual market itself. But at the end of the day, the options can be a huge benefit, because if you can understand that, you can also use it to your advantage.
All right. Well, we often talk about the downside risk, but with stocks, there is obviously sometimes this in a stock, there's an upside risk in a way. And what I mean by that is sometimes you can get a little bit greedy. That happens, I think, a lot with options. Do you have any rules of thumb, like on the upside, that maybe where you're going to get out of a position, something like that?
Yeah, the number one thing is there's nothing wrong with taking profits early. There is nothing wrong with executing a great trade that worked out the exact way you wanted and taking profits on the way up or when it hits your profit target, even if the stock continues to rise and it skyrockets. What you need to focus on is, are you making good trades consistently? There's a lot of times where something will run higher and you'll say, geez, I sold out way too early. But a lot of people aren't giving themselves enough credit for just making a good trade, because nobody knows where the top is going to be. Nobody knows if somebody with a massive account is just buying this because they had a crazy weekend with the stock or something happens. And so you never know where the top is going to be. Do not get greedy. Try and get to first base 3 times instead of hitting a home run. It's going to be much better for you in the long term. It's going to be better for your mental health. And if you can develop a strategy and a trading system that is consistent, that is much better than a trading system that is volatile and reliant on trying to pick the top or hit home runs.
All right. Well, speaking of which, what type of stocks do you typically like to trade when you're scalping options?
Yeah, for me, like I said, I really focus on options where I can get in and out quickly. In general, that means the stocks with the largest volume. And in the current market, a lot of that kind of revolves around tech and big news that is coming out. So over the last year, I would say I've been primarily focused on sort of the Mag 7, the Apple, Amazon, Teslas, the Metas, the companies that have high volume on the stock, high volume on the options, and the ability for me to get in and out. And so for me, I'm primarily focused on the larger cap, the blue chip, the technology stocks, because I find that they give me the liquidity, they have tighter spreads, and I'm actually passionate and interested about the industry. And so I'm learning about it. I understand it. I understand what this type of partnership is going to mean. I understand what this type of news could mean. And so that gives me an advantage and an edge in the marketplace, I believe. And so I try to focus on basically the large scale tech industry. Unless there's a very strong trend that I'm identifying in another industry, I will try and do as much research as I possibly can on that industry and take advantage of that trend, as long as it still meets my requirements and gives me the ability to get in and out of that position.
All right. I want to expand on that a little bit more, Zach. What are some of the key factors that you need to see or that you're looking for that tells you a stock would be a good candidate to day trade options against?
Yeah, so when we're evaluating that, it's kind of a checklist. Does it have the volume for actual transactions going through on those options? So usually I'm looking for at least a couple thousand per day at an absolute minimum. That way it gives me the ability to trade with other people when I make my decision to buy or sell, or my take profit or stop loss gets hit. The other thing is the spread, the difference between the bid and the ask. If this is a $1 or $2 option, but the spread is set at 50 cents because there's not a ton of other people trading it, that's a big issue for me. And it means that it's really going to hurt my profit and loss if I need to get in or out quickly. So those are the two things that I primarily focus on. The next one is position sizing. I look at my portfolio and I say, okay, I'm willing to lose $1,000 on a trade. If my stop loss is $5 underneath my entry point, that means that my position size is going to be 200 contracts or 200 shares, depending on what we're trading. And that's what I go with. And so it really depends on your personal style and what you're comfortable with. But for me, when I'm looking at stocks to evaluate, it's, can I get in with the right position size? Can I get in with the right liquidity and the spread? And is this a company that aligns with the big market picture? Is there a trend that I'm watching and that I'm interested in right now? And is this one of the stocks that is going to benefit or get hurt from this trend? So that's sort of the checklist I go through.
All right. Excellent. No, that sounds like a great checklist to use. I know one of the things you've already mentioned that you are looking for is technical analysis, so technical indicators. Our audience is always super interested in this. Can you help us find or figure out what sort of indicators you like to look at on a stock, like on a stocks chart, to help you spot trading opportunities?
Yeah. When I first started out, I took that university course and they taught us about 13 different indicators. And so I lined up all 13 indicators on my chart and I told myself I'd buy when all 13 lined up. And the reality was that never at once did all 13 line up. And I realized maybe this isn't as simple as I thought it might be. And so over the course of a few years, what I realized was keeping things as simple as possible is usually better for me personally. And so on my charts, my primary focus and the thing that I am analyzing and that I'm looking at mostly is the price action. And when I say price action, what I mean is, what are the actual candles doing and where are they hitting support, resistance, or trend lines relative to the price? So for me, that is the number one thing that I am focused on. On top of that, though, I add some indicators to help me understand the price action. The indicators that I have are simple moving averages, maybe a VWAP, and I put the volume underneath the chart, and I match the volume to the candle color. But other than that, there's not usually a whole lot on my charts. It is not bogged down with indicators. It is not bogged down with different levels and things like that. I'm focused on major levels of support and resistance. I'm sometimes adding the RSI and the MACD for confirmation, but the main things that I'm looking at are price action, and then volume would be number two. After that, I'm using everything else for either confirmation or to just double check what I'm seeing.
All right. For anybody that's a newbie on technical analysis in here, can you elaborate a little bit on what does it mean by price action?
Yeah, so when I say price action, what I'm referring to is the price is displayed in candlesticks that are usually red and green. And so when I say price action, what I'm referring to is what does the movement of those candlesticks look like? Are they going up to a certain level and then getting rejected 3 times in a row or 4 times in a row? That would show me a level of resistance and something that is a key area I would want to watch for. Yeah, here's the perfect chart. So if we see the price action on the bottom left here, we can see that the price action bounced down to the strong support level twice right there, and then bounced up and broke above the minor resistance level. That would be a very strong indication of a buying opportunity. You would cross-reference that with what you're seeing in the market, what you're seeing in the trend, what you're seeing in the rest of your indicators, and you'd say, okay, this looks like an excellent opportunity to get into the position, set a stop loss below the minor resistance, and see what happens from here. In that scenario, I'm usually looking for a 2-to-1 risk to reward ratio, which means if my stop loss is $2 below my entry point, I'm looking for an initial take profit level of $4 above the entry point. But when it comes to technical analysis, this is the number one tool that I use, and it's looking at the price action and trying to evaluate and identify these areas of support, the areas of resistance, or if the price is moving in a channel in a direction where it's consistently setting higher highs and higher lows, for example. Those would be things that I want to draw out on the map. I want to keep an eye on. I want to add them to my watch list. And then when we see a strong bounce off of support, or we see a breakout of resistance, or we see the price collapse back down through support, those are all opportunities where I would be looking to evaluate an entry point for a trade.
All right. So you've used the charts to determine an exit and entry point quite a bit. And that was an excellent, graphic to help us with that. Once you get to that point, how do you choose an option strike price and an expiration date when you're scalping options?
Yeah, so when it comes to strike price and expiration date, a couple of things to factor there. For me, I'm usually looking for a expiration date that is expiring in that week. The reason for that is because those are the options that will usually be the most volatile. That volatility gives me the opportunity as a trader to take advantage of those price swings. When it comes to the actual strike price, I'm usually trying to stay around the current market price of the stock. The reason for that is because those are the options that will usually have the most volume. And so by staying with a expiration that is coming up relatively quickly and staying with a strike price that is around the current market price, that gives me the ability to usually find contracts that have high volatility, have low spreads, have good liquidity, and give me the ability to get in and out quickly. I am not super set on hard rules about strike prices and expirations. What I'm more so trying to do is say, okay, if my initial position is going to be $1,000, let's say, I need to buy a contract where ideally I can buy 2 or 3 contracts and I can size in or size out if I wanted to. At least I have that option at that point. And I would like it to have the good liquidity, such as tight spread and high volume. And so if it checks those boxes, that is what I would be comfortable trading. Usually there's 1 or 2, maybe 3 different contracts, depending on the security, and whichever one fits my port or my position size the best is usually what I'll go with.
All right. So I want to get to the idea of a plan. You probably heard that famous saying, if you fail to plan, you plan to fail. Many option traders swear by the importance of a trading plan. So what does your typical trading plan look like when you're scalping your options?
Yeah, so my trading plan is based on research. It's based on me doing my analysis and identifying what direction is the overall market going in, What direction is this specific industry going in? Why is this industry moving in that trend, either bullish or bearish, and trying to do my research there. And then, like I said before, I'm trying to find the best or the worst companies in that industry that are going to benefit or get hurt by that trend. And then I'm zooming into the stock. And what I'm looking for is I'm looking at the stock and I'm marking out those support and resistance levels, and I'm adding it to my watch list. And so my routine or my process or my trading plan is about identifying opportunities, getting them onto my watch list that is going to basically hold all of those opportunities. And then every morning I'm evaluating what's happening in the market and then going through those opportunities to figure out, is there a trading opportunity based on the technical analysis that I've done and what has happened since I last looked at it. And so my trading plan is basically me trying to find the best opportunities in the market, putting them all together, and then monitoring them until I find an appropriate buying or selling opportunity.
All right. Yeah, some great tips there for sure. What are some things you like to do to help control the amount of risk? I know we've talked about risk already quite a bit, but we haven't really talked yet about how do you necessarily control it or possibly maybe minimize or mitigate some of the risk when you are day trading options.
Yeah, so when it comes to risk management, I think it's really, really important for most people to enter a position with a stop loss. It fixes your risk, it fixes the downside, and it basically gives you a marker of saying, this is where I was wrong. This is where, if the price moves here, my hypothesis and my analysis is wrong. So that's how I determine where to put the stop loss, is if the price moves to this level, it proves me wrong, that's where the stop loss should be. Now, where your entry point is, that difference there, that is your risk. And for me, I want to trade with at least a 2-to-1 ratio. And so if my risk is $2, I want my return to be at least $4. That's how the position works there. But when it comes to managing your risk, you need to have that stop loss in place, because it's basically what helps me set my take profit level, but it also helps me manage and control my downside on every single position. And so a lot of people don't do that, and or they kind of enter a position and then do it afterwards. And I'm pretty opposed to that. I think it's something that you should have when you enter the position. If you're trading stocks, the trailing stop loss is my personal favorite, because it will actually move up as your stock moves up. One of the most important concepts that I think nobody really talks about is, if you enter a stock at $10 and your stop loss is at, let's just say, $7, that means your take profit might be at $16. Well, if the stock moves up to $14, you now have a stop loss at 7 and a take profit at 16, which means you are going to make 2, but you're risking $7 here. And that is a terrible ratio. Obviously, nobody would take that trade. And so what I do is, as the trade works in my favor, I move that stop loss up to try and lock in profits, but also reduce the risk on that trade, because that risk to return ratio trades as the stock moves or as the option moves. And so it's really important to either have a way to adjust your stop loss using a trailing stop loss, or to adjust it manually periodically, depending on how the trade is going. But managing your risk, the largest tool you can use there is your stop loss, and the second largest tool is proper position sizing. And so figuring out what your maximum loss that you're willing to take on a trade is. Let's say it's $1,000. Your stop loss is set $5 below your entry point. That means that your position size is only going to be 200 contracts or 200 shares. And so having the right position sizing and setting a stop loss on every trade, that will cover probably 90% of your risk management plan. And then after that, it's just small details about managing maybe diversification and what trades you're taking.
All right. I think I've seen on your channel before too, you mentioned, like, are there any specific events or big things that you like to avoid from a pricing perspective?
Yeah, there's a couple of events that I don't like. The largest one is the Federal Reserve and interest rate announcements, or the Bank of Canada and interest rate announcements. I try to stay pretty far away from those because those are announcements that could change the entire market in a way that's just really difficult for me, at least, to predict. I struggle to say the market's going to do well or poorly based on interest rates. And so it's something that I'm just not good at. And so I avoid it. And what has happened is I've tried it. It hasn't worked for me. I've documented it. I look at my journal and I say, wow, I'm not good at this type of trading or this type of investing, and so I stay away from it. And so for me, it's about trying to identify what I'm good at, and that is usually the 9:45 to 11 a.m. segment of trading, usually around stocks that I'm interested in and an industry that I'm watching closely. Whereas the economic events are things that I am not an expert in, and so I stay away from.
All right, excellent. All right, we're going to get to a really good part here, Zach, in terms of filling us in on the details of your approach to day trading options. I want to see if you can take us through an example. Can you walk us through an example of how you entered and exited a recent options trade? I think the audience would love that.
Yeah, please. So do we have the chart for Apple? Yeah, perfect. Okay, so this is a really good one here because it's just pretty clean and simple. And so this is the Apple chart on 1 minute candles. The black periods where you see the most movement, that is the open session, and then you've got pre-market and post-market in the brown and the green there. The important thing to realize here and to look out for is the key levels of support and resistance. And so if you look at around 11 o'clock, I believe it is on the 11th of February here on the far left of the screen where that orange dot is, you can see that we reached a high of the day and we got pretty strongly rejected and we went back down in a trend that was bearish all the way until the close of the day. That high of the day in my mind is a pretty key level because we got rejected at it. It had decent volume there. You can see a small spike in the volume, and there was obviously somebody or a group of people that were selling at that level. The next day, we climbed back up to that exact same level. We had a little bit of choppy trading around the middle of the day, and then we were able to break through that level at the end of the day. That's a really good sign because it shows that, yes, that is a key level. We've got some action happening there. We've got some buying and selling happening there, and it is something that I want to be watching for. The next day, we go into pre-market, and you can see that basically the stock bounced off of that exact same level again, that $235 level, and it sort of traded sideways through the pre-market. When the market opened right around 9 o'clock there, you can see a huge spike right at the beginning of the day, and then it dropped back down. If you are new to day trading or trading options, what you will find is there's always going to be a massive influx of volatility in the first, let's call it 2 to 3 minutes of the day, and then it settles out a little bit and the trends are a little bit easier to identify. I never trade in the first 5 to 10 minutes of the day because honestly, I just don't have enough data most of the time. And so I try and sit back, I try and let the trends establish, and then I look for an opportunity to get in. When I'm evaluating this chart, what I see that's really, really nice here is that the stock opened a little bit higher, it came back down, and it hit that exact same level, right around $235. It was a level of previous resistance from the 2 days prior to that. We found a little bit of resistance and then used it as support as we broke through on the day prior. We tested it in pre-market on the 13th, the day that we're looking at on the right side there. And then we saw a very, very strong bounce off of that level, basically about 20 minutes, half an hour into the trading day on the 13th of February. And then what was beautiful about this is that I was watching it. I'm looking at entering into a trade because I've identified an area of support. The stock is coming down. I'm looking for it to bounce off because we've already done that. We've already broke through it. And what happened was Apple released an announcement about a partnership with Alibaba around artificial intelligence. And if you've watched the market over the last 6 months, you know that announcements about AI in almost any way have usually been a very, very positive catalyst. And so when I looked at this trade, I said, okay, we're bouncing off a key level of support here. We're crossing through our moving average. We've got some great technical indications here. And now we've got a catalyst in the news that could drive this price higher. And so this is what the stock chart looked like. And if you looked at it, the price ran from $235 up to basically $41.50 at the height of this first run, basically in the first 2 hours of the market here. And so it moved maybe $5 or $6 here. But if we can move over to the options screen now, this is where the real advantage comes in. This is the exact same chart. It's zoomed in a little bit, but this is the options for Apple. And so what we are looking at here is one contract of these, or one option was ranging and started the day at around 20 cents. It dropped down to a support level around 9 cents, the same price action that we were seeing in the stock and the same support level if we expanded this chart out. And then we saw a bounce off of that level in line with the stock and in line with that news announcement. We then broke through our moving average. We broke through the other resistance levels around 20 and 26 cents. And that was my confirmation to get in. We had great technical analysis. We had great indications of a buying opportunity. We were also starting to see increases in volume, and we were breaking out of key levels. And we had the news catalyst as basically the cherry on top. And so I had a ton of confidence going into the next 10 to 20 minutes that this stock was probably going to do very well. And as you can see, the stock ran up from the low of 9. My entry point was around 30 cents, and it ran up to $1.31. Now, I didn't sell out at $1.31. I basically took it in 2 segments on the way up and did pretty well on the trade. And I'm not kicking myself for it either. But this was the process that I went through. It starts with the big picture. It starts with putting the stock on my watch list, and then it goes into technical analysis. And then I'm waiting for an opportunity. And then we had a catalyst on top of that. That's kind of like the holy trifecta for me. And this was a trade that worked out well.
All right. Well, that was a great visual, Zach, and I think a fantastic explanation. I think our audience would love that, or does love that, to be able to put the pieces together. So thanks for walking us through that. And speaking of the audience as well, if you are enjoying the show so far, make sure that you subscribe to the TD Direct Investing YouTube channel. And if there's a topic that you'd like to learn more about, let us know in the comments. Plus, you can follow us on Instagram at TD Direct Investing to get a sneak peek at upcoming shows and a ton of other content designed to help you build your investing knowledge. All right. So, Zach, we're going to move on to a different segment. Something that we like to do recently on Inside Investing is we want to look at a certain clip, and I want to get your reaction on this. So we've heard a lot about interesting perspectives on your program in the past. So we'd like to bounce some of those ideas off of you to see if you agree or disagree and why. Okay?
I love it.
So are you all right with that?
Yeah, I love it. I'm excited.
Sounds good. Awesome. All right. So the first one I think we have set up to go is first idea comes from Patrick Sresna. He's from Big Picture Trading. He says that following too many technical indicators can actually work against traders.
When you rely too much on indicators, you are putting too much importance on the indicators, and subsequently, you're not studying the price. And price action, to me, is critical. And so I would say 3 is the max. And if you can wind it down to 2, it's even better.
Yeah, I don't think I could agree more with that. A lot of people really try and overcomplicate trading and add too much to their screens and think that it's going to help them, when in reality, it just gives them contradicting signals and it makes it more difficult to make a clear decision. I think especially for new traders, that is a trap that a lot of them fall into. And as I get older and older, I'm actually just trying to simplify my trading more and more. The less hard decisions I have to make, but still get the same results, the better. And so the more simple that you can make your trading, and the easier that you can make it to understand for yourself, the better. Because the reality is that, especially if you're trading quickly, there's almost no human on the planet that could analyze 13 indicators and execute trades and compare it to the market. Like, it's just too much going on at some point. And so I completely agree with what he said.
Yeah, I know in your example, your charts look really simple in terms of your moving averages and some of those price lines. Is there a magic number that you use when you're adding technical indicators? What's your kind of magic number that you would use when you're scalping your options?
I guess it kind of depends on the person. Like for me, volume, if you call that a technical indicator, volume is the number one for me. After that, it's a moving average that just helps me identify whether or not the stock is in a new trend or is changing trends. And then the MACD and the RSI are kind of tools that I use for confirmation, but I don't make decisions based on the MACD or the RSI. And so If you can go with volume, a moving average, and maybe one other tool that really helps you, I would say that's probably the golden ticket, or that's probably at least where you should be starting.
Okay, excellent. All right, so we're going to do one more. We have our next idea comes from David Keller from Market Misbehavior, and he shared a technical trend that he's found useful for figuring out when to take profits in a winning trade.
When the RSI is overbought, when we're making a new high, and then we make another new price high, the RSI is no longer overbought. And so that divergence, higher prices, lower RSI, usually suggests we're at the end of that bullish phase. We're at the exhaustion point of that trend. Any sort of winning trades, any positions that are continuing to gain, I'm always looking for a divergence that might tell me sort of that early warning that we might be in a position where that uptrend is exhausted. You might want to think about downside risk and maybe locking in some of the gains that you've experienced so far.
All right. So what do you think about that technical trend? Do you think it would be useful for you in scalping options?
I think it would probably be useful. I would say I probably do something similar to it right now. For instance, I sort of do the same thing with volume. If we see a stock that is setting higher highs or is moving higher and the volume is increasing with it, that's a very good sign to me. But if we see a stock where it is setting a new high or it is pushing higher and the volume is dropping off, that would be a big red flag for me. And so sort of a similar concept, I would say. I probably apply the exact same principle, but I do it with volume. So I could totally see it working with the RSI, and probably a great strategy.
All right, excellent. I appreciate your thoughts on that, Zach. That's amazing. I think that worked really well. And just a quick reminder to our audience, you can find links to all the episodes we've referenced here in the resources section of the broadcast console. So make sure to check it out before you go. And you can also find them in the Learning Center on WebBroker and on TD's YouTube page. All right, so Zach, just one last thing before we get to our Q&A. I really appreciate you filling us in on your approach to day trading options. So we're going to hop into Active Trader to show our viewers how they can add similar drawings and technical analysis tools that some of the ones of which that Zach highlighted today. So we'll watch a quick clip there and see if that will help our viewers as well.
All right, everyone, I wanted to take a few minutes to show you how to set up your charts in the Active Trader platform. One of the first things you may want to look at is your time frame or your duration. Right now, we're looking at a common 1 year, 1 day chart represented in the candlesticks. If we want to change that to something shorter as a more of a custom time frame, we can do that down at the bottom. As you can see, I have a 1 day, 1 year available, and I can click this plus sign to change it to possibly maybe a 5-minute aggregation for a 1 day time period. So once I've added that in, all I have to do is click save, and it's automatically going to take me to that chart, and that's going to be available going forward. After that time period, now we can start to look at adding drawings. If we want to add drawings, we can go to the left-hand side, and we can see here where there's trend lines, extended lines, there's channels. But for today's purposes, let's take a look at a price line, which we did see today. If we grab that, we click that, and we move it to where we want to set a certain area of support or resistance, you can add multiple lines. But once you've added that on, you can now click this menu to change some colors. You can change the line thickness. You can lock the line in place. And you can click this settings or this gear to change some other parameters as well. Once we've added our lines, we can add, as we know, we can add multiple lines if we want to do support and resistance or other trend lines as an example. We may want to look at adding some studies. So if we click at this F for function under the study settings, we can now start to search for all the available studies. For example, if we go to moving average, there's multiple moving averages available. There's exponential, there's simple. Let's add a simple moving average, and you can see we can change the parameters, the length, we can change the colors, and we can also change the thickness as well. So if we change a number here as an example, if we go to 21 bars, and once I click close, you can notice we have a pretty prominent moving average added into the chart. After that is done, now we can look at adding additional studies, possibly some lower studies that would be available, such as an RSI or a MACD. So if we type in RSI, which we know is a well-known lower study, we can double click that. And now we have the ability to change some of the parameters or the colors for that also. Click close, and that is available as a lower study for you in your chart. So that's not everything you can do. There's so much more you can do within the charts with an active trader. But just to get you started and show you a simple way to add some of the studies that are going to be within the chart itself and lower studies as well, and adding some drawings that you may utilize to help you identify that trend. So that's just a quick nutshell to show you how to get started with charts in active trader.
All right, Zach. So we're going to have to leave the interview portion of our conversation there. I was having a great time, having a lot of fun hearing what you had to say, but we're not done yet. We have the question and answer. I know I want to give enough time, give a good amount of time for our audience. I know we were usually going to end at the hour, but if you're okay, would you be all right to stay for an extra 5 or 10 minutes so we can squeeze as many questions as we can?
Yeah, I'd be happy to.
All right. So are you ready to hear what our audience wants to know more about?
Let's do it.
All right, let's check it out. So, and just a reminder too to the audience, we are going to put up a poll. There's a poll that you can read through and you can vote on. There are a lot of common questions that we receive from the audience. There's amazing questions that are coming through. But vote on that poll. Take a second to vote on that poll, and we'll grab some of the top questions that you voted on, so we can make sure we capture a number of questions that have come through all at once. But while we're looking at that, while you guys are looking at the poll, I just want to remind everyone, put your questions in. We'd love to hear from you. There's a great question here from Dennis that we'll put up on the screen. Actually, we may not be able to while the poll's there, but I'll read it to you, Zach. So how are you using AI to make you a better trader, and how do you utilize it to gain an edge in the market?
How do I use AI to make me a better trader? This is something I'm still experimenting with a little bit. I think the number one thing that I've done is I track all of my trades in a trading journal, and so I've submitted my trading journal to a couple of these different AI chatbots and said, hey, what do you think of this? What do I need to improve? What am I not good at? Is there any patterns that you're seeing? Is there any analysis that you can share with me? And it has been able to give me a few insights, such as I'm not very good at trading economic events was actually one of them. Another one was that I'm not very good at trading those first 5 minutes of the market when things are moving really quick and there's orders built up. It's not my strength. I'm better at using a little bit of time and a little bit more analysis and waiting for the trend to form. And so I think the first and the easiest thing you could do to implement AI to make you a better trader would be track all of your data and then use AI to analyze that data, because it will probably do a much better job of analysis than you'll be able to do.
All right. Well, that was a great first question. Thank you for that. And so I have another really interesting question from Akshay saying, why don't you follow the advice of, be greedy when others are fearful, and instead you follow the herd following the trend?
Be greedy when it comes to scalping options, we are working on such short time frames that it would be tough for me to analyze whether people are being greedy or fearful at the time. So I would say in a long-term investing environment, I totally agree with that sentiment. You should be buying when people are selling, and buy valuable securities that will do well over the long term. On the shorter time frames, I would say that is just much more difficult. And with the volatility and the quick price movements that you'll see in options, I am just much more comfortable, and I think I'm better at trying to go for consecutive and consistent smaller wins rather than trying to hit the home run. I do try and let my trades run as much as possible. I do try and take advantage of, if the trend is going in my way and the trade is working out great, I would try and move that take profit level up as much as possible. But again, I focus on trying to get through the day with 2 or 3 really good trades that are good quality, rather than one that just did extremely well or one that didn't do well.
All right, great answer. So now we're going to pull up the actual results of the poll. We'll see which ones had the highest voting here, and we'll ask those to you, Zach. So I can see it looks like we have one that's about 40% of the audience. So how do you use stop losses with options? The spreads fluctuate, so it seemed to me that it's not possible to set a stop loss for the option. What are your thoughts on that?
Yeah, so this sort of goes back to that system of how do I actually figure out what stocks I'm going to trade. If you are trading an option and the spread is too large and the volume is too low for you to set a stop loss, that is an indication that it is probably not a good option to day trade or to trade short term. And so if you're running into this scenario, I would say that you need to go with a shorter expiration, or you need to go with a strike price that is closer to the market, or you need to go with a stock and option combo that just gets more volume. But if you're getting into trades where there is not enough liquidity to set a stop loss, I would avoid trading that in the short term unless you're trying to hit home runs, I guess.
All right. So let's go to number 2 on the poll. And so the next highest votes was, can you explain selling put options as a way to earn income and how to exit?
Yeah, so selling put options as a way to earn income. I don't have a whole lot of experience with this, and I don't sell a lot of put options. There's a couple of stocks that I probably would, but selling put options, it's the same thing as selling a call option to earn an income, but the stock is going the opposite direction. So it's sort of the same principles. And then how do you exit it? How do you exit it? Is it, instead of selling it, you're buying it to close. So same sort of mechanism and same sort of process. The terminology is slightly different, and the end result is the opposite, but very similar to selling a call option.
All right. So we are going to put up another poll. So we'll put up another poll that you can all vote on, and let us know what your favorite questions are. We'll ask Zach a couple of those as well. But in the meantime, as you're taking a look at the next poll, I do have a question from, looks like it's from Carl. Carl is asking, can you explain options as insurance for stock holdings in my portfolio?
Options for insurance, so hedging basically, I think, is what he's probably talking about there. If you own a stock position and you are worried that there's going to be a market correction, or you're worried earnings come out and the stock is going to tank, what you can do is you can take a small percentage of your portfolio or of your cash position, or you can sell a small percentage of those stocks to get some cash, and you can buy a call option, or in this scenario, it would be a put option. And so you hold the security, or you hold the underlying stocks. If the stocks do well over the next 6 months, your put option is absolutely worthless. But if the stock crashes over the next 6 months, your put option is going to be extremely valuable. And so it will offset the loss from the stocks with the gain that you make in the put option. And so you can use options in order to hedge and protect your portfolio if you are worried about a massive correction or a downturn or a change in the stock price that would significantly hurt you. I believe that's what he's talking about.
Yeah, I think that's absolutely right. Another thing just to add to that too, Zach, is that I do it quite often as well, is if you do have that big drop in the stock, you're absolutely right. You could sell it, sell it in the market, keep your stock and maybe offset potentially that loss, or you can exercise that stock. If you're okay with getting out of the stock, you can exercise that put option and sell it at a much higher price. So that's another way you can do that too with put options. But yeah, that was a good explanation for sure. Okay, so we have another question. It looks like from Harvey. Harvey is asking, he's got WL ratio. So I'm assuming he's meaning, what is your win-loss ratio and what is your RR ratio? So I believe he's saying risk-reward ratio for your trades.
Yeah. Risk to reward ratio for me is a minimum of 1 to 2. So if I'm risking $2 with my stop loss, I want to be able to make at least $2 per option or contract or share. And then my win ratio is usually around 60 to 70%. Kind of fluctuates up and down from there, but my wins are usually much larger than my losses because of that risk to reward ratio.
All right.
And I think that's actually an important topic, maybe, is that you don't necessarily have to win more than 50% of your trades if you have the right risk management and position sizing and return ratios in place. So that's something to consider as well. A lot of people get hung up on what percentage of their trades they made money on. But if you make twice as much money on your wins as you do on your losers, you could win less than 50% of your trades and still be profitable. And so I think that's one thing that not everybody realizes about trading.
Yeah, that's a great insight. All right, so we have our next poll. Results are going to be up there on the screen. You should be able to see them. And looks like the big winner in terms of the voting is What about covered call option strategy? How do you choose strike price or expiration date? That's a hot topic for sure.
Yeah, that one is tricky. There's a couple of different methodologies and strategies and philosophies around that one. For me, most of my covered call options are usually around 3 or 6 months in length, and so I basically look at the last 1 to 2 years and I say what has happened over the last 1 to 2 years, and what does the growth rate look like. And if things go well, where do I think that stock is going to be at? And let's just call it 6 months. And I set my strike price just above that by, let's call it 5 to 10%. And so my goal is I want that stock to increase to just below my strike price so that I get to keep the premium and the value of the stock increases. And so it's a balancing act. It is not a pure science, but what you want to do is you want to set that strike price at a level where you would be like, wow, that stock performed extremely well. And if I had to sell there, I would be happy with it. And if it doesn't get to that level, at least you still get to keep the premium. And so what I would do is I would say for most call options, like a minimum 2 months, maybe 6 months, maybe a year. And I would say, where do you think that price is going to be in that time frame? And you need to set your strike price just above it. The expiration is probably going to be more dependent on how often you want to look at it. So for instance, if you're checking your portfolio every day, then maybe a shorter expiration of 1 month, 2 months is great for you because you're going to stay on top of it. But if this is something that you only check once a month at the end of each month, then you probably want to focus on something that's 6 months or 1 year away. And so that's how I would choose the expiration date. And then the strike price, I would put it right above where I think that price is going to be at that time date.
All right. Yeah, there's some good advice there for sure. Okay, what we've got next is it looks like a couple were a tie and this one's slightly above. What is different between day trading and swing trading?
Yeah, super simple. Day trading is buying and selling within the same day or the same trading period. Swing trading is holding for at least 1 day and usually less than a year. Anything over a year, I would consider an investment or long-term investing. Swing trading is where you're buying it and holding it for at least 1 day. Most of the time, for most people, this usually ends up being a couple of weeks to maybe 2 or 3 months. And the idea here, what you're trying to do with swing trading is sort of like I said before, you're trying to identify a trend in the marketplace, advantage of that trend. You are not planning to hold this stock for 5 years and add it to your retirement portfolio. You are just trying to take advantage of the change in price that you have identified with what is going on in the trend in the market. And so swing trading, a little bit longer term. Day trading, buy and sell within the same day. Investing, in my mind, is anything over a year.
Okay, great explanation. All right. So we have a question here from Joseph, and let's test you here on this, Zach, see if you have the stats. You may not have them readily available in your mind, but we'll see what you've got. But Joseph is asking, how often would your stop loss get triggered? Like, what percentage of your trades do you think?
Yeah, 30 to 40%. Yeah, pretty. Right. Yeah. In that range, I would say probably like 1 in 3 trades don't go my way, and 2 out of 3 trades at least make a little bit of money. Probably one of them works out perfect, one of them works out okay or moderately well, and probably one of them hits my stop loss. I would say that might be the average if you looked at all my data.
Okay, awesome. I was impressed you had that quick. You had that at the ready.
AI analysis. That's what it's all about.
Perfect. I love it. All right. And then, so we have another one from, it looks like it's Juvelin. Juvelin is asking, what screener do you use and what do you look for in screening stocks and options?
Let me pull it up right now. It's called stocks.io. It was actually, it's been really good. You can kind of sort by all the different filters and sort by all the different kind of attributes that you would want to search for. For me personally, though, I will tell you that I don't incorporate a stock screener into my daily routine or my day-to-day trading. I go through that process that I sort of told you about. When it comes to trading options, I don't have a ton of different securities that I can buy and sell quickly because of the liquidity and the spread requirements that we discussed. And so the screeners don't help me a whole lot when it comes to trading options. When it comes to day trading the actual stock itself, it's a lot more useful. I focus on volatility, I focus on price ranges, I focus on market caps, usually the smaller market cap stocks that are moving quickly, and I use stocks.io as the screener.
All right, excellent. Some great tools to consider. And one last question. We'll see if we can get one more in here. What is the ideal time period when looking at technical indicators? Is it 1 day, 1 week, 1 month? What's your opinions there?
I love this question. This is a question that doesn't get asked enough. So what you need to do here and what you need to think about is you need to match your time period to your style of trading. So if you're a long-term investor that is investing with a 1-year horizon, you should never be looking at the 1-minute time chart. You should never be looking at the 1-hour time chart. You should only be looking at 1-day candles and maybe even 1-week candles. You need to look at the big picture because you're making a big picture investment. When you are day trading and you're buying and selling within the exact same day, you need to understand the big picture, but you need to be looking and trading off of 1-minute candles, 5-minute candles. You need to be looking at the shorter term trends while understanding the big term trend. And if you are swing trading where you're buying and holding for a couple of weeks, you're probably looking at 1-day candles over a 6-month, 1 year, and 2-year time period, and basically narrowing down your opportunities to the best one. And so when it comes to time period, your time period needs to match the style and the length of the trade that you're planning to make. Shorter term trades need shorter term candles. If you're making a 1-year trade, you should never look at a short-term candle.
All right, I love your passion about that answer. That was amazing. So that's great to close off on an amazing question like that and a great answer. And but we're gonna leave it there. Zach, is there any final thoughts that you would like to share with our viewers?
No, I think the big thing is before you get into options or you get into day trading stocks, make sure that you understand the actual functions of the market. Make sure that you understand how it works. Make sure you understand how the order types work, what the different terminology and the lingo means, and then probably start with a practice account. If you're doing any short-term trading, I tell everybody to start with a practice account. I think TD has a great one, and so I would really focus on taking it slow. You're not going to be a millionaire overnight. This is a skill that you need to develop. And if you think about it, you are most likely to lose money in the beginning. And so if you can get through that phase with practice money or with fake money, and you can get the battle wounds and you can learn from it and you can improve your strategy over time, that is going to be the best thing for you. Because if you put yourself in a hole right away, you just got a whole lot more to climb back out of. And so take it slow, understand the basics, learn the fundamentals, start with a practice account, then start with a small portfolio and slowly expand from there. There's no rush. There's no need to jump into this right away. I can promise you it's not going to happen right away. It is a skill that you need to build up and that you need to learn over time and that you need to practice and refine. And what I tell people is the more that you can test your strategy, capture data, analyze data, and then improve your strategy, the more that you can do that loop, the faster you will improve as a trader. So that's what I try to focus on.
Yeah, the thing I'd love to double down on too that you just said is that practice account. I did that for a long time, and even just learning the option concept will help with that practice account. And then when you start trading a little bit, I think it's a different story when you get into using your own money, but just having that risk and knowing what kind of things can happen within that practice account is extremely valuable. So I'm glad you said that.
Yeah, it makes a big difference. And let's be honest, like these options are complicated, especially if you're just learning about it for the first time. And I tell you that there's call and put options and you can buy and sell both of them. Like there's a lot to it. And so if you're new to this, you're just getting started, take it slow, learn the basics, test the basics, and just build on it. It's like a pyramid where you're just going one layer at a time.
Absolutely. All right, so we're going to close off. Just for the audience, I want to remind everyone, this session is available. It is going to be archived. It'll take a few days to where it is available where you can watch it back. You're going to get an email. So anybody that attended, you'll get an email telling you when it is ready. But a reminder as well, if we just kind of go around the console, that there is a survey. There is a survey to let us know how we did. I think Zach did a fantastic job on his answers, and I hope you really enjoyed the show. Also, there is a previous webinars that we have, you can actually register for many of those if you want to watch them on an archive basis already. And we do have in the middle of the screen, you can see there, we have upcoming webinars. So if you're loving this type of session, if you've never been to one before, check out more. We're doing this all the time. You'll have several that you can register for and participate in the future. So I want to say thanks again, Zac, for joining us. And for those in your audience, make sure to register for those upcoming events I just mentioned. And you can check out our library of on-demand content available in our Learning Center on Webroker and on our YouTube page. So there's all kinds of places to find this great content. So that being said, Zac, thanks again so much. We appreciate it having you here. And thanks to our audience. Keep learning, everybody, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.